Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings for the second quarter of 2023, and that stock is Chipotle. And as we can see, over the last year, Chipotle is up 25%, while the rest of the market is only up 11%, so they are outperforming the market over the one-year chart. So in this video, I'm going to look into some of the recent news that came out surrounding Chipotle. I'm going to look at their financial statements, and I'm going to use a discounted cash flow model and a weighted average cost of capital for Chipotle to figure out their intrinsic value per share. So right here in this article, it's titled Chipotle shares slide as sales fall short of Wall Street's expectations. Some key points I touch on right out of the gate include the fact that Chipotle Mexican Grill said last quarter that it was done raising prices, but executives appear to have opened another round of price hikes. Also, the company's stock year to date is up 50%, but it fell after they announced earnings. They basically crushed earnings in their earnings report, but their sales fell short. They reported $12.65 per share of earnings, which was better than the expected $12.31. But then they ended up reporting $2.51 billion of revenue, which was less than the expected $2.53 billion. For their second quarter, they reported net income of $341.8 million, which is up from $259.9 million year over year. Right here, they point out that sales rose 13.6% to $2.51 billion in the second quarter, and that mainly came from same-store sales, which grew 7.4%, but that fell short of the expected 7.5% growth in same-store sales for Chipotle's second quarter. But they basically said that they aren't seeing weaker demand from lower income or higher income consumers at the moment. Digital sales accounted for almost 40% of the company's total food and beverage revenue this quarter, which is very high. And then lastly, right here, they point out that Chipotle opened 47 new locations, and 40 of them included drive-through lanes that allow people to pick up digital orders. So they're expanding their business. Their earnings dominated analysts' expectations, but unfortunately, their revenue fell short, which is why their stock price tumbled very slightly after they announced earnings. Right here, these are their financial statements. We can see their balance sheet. Total assets are up from $6.9 billion to $7.5 billion. And then we can see they have around $2.7 billion of shareholders' equity and $4.7 billion of liabilities. So most of their business is financed by liabilities compared to equity. And then also retained earnings is up from $4.8 billion to $5.4 billion. So they do have more cash to distribute to shareholders if they want to. Right here on page 4, they have their income statement. Total revenue is up from $2.2 billion to $2.5 billion, an increase of 13.6% year over year, as the article stated. And then net income is also up from $259 million to $341 million. That's an increase of 31.5% for their bottom line net income. The increase in their net income, which is greater than their revenue, obviously shows that their cost of revenue didn't increase as fast as their revenues increased, and as a result, their net income ends up increasing a lot faster than their revenues. Then lastly, right here on page 6, their cash flow statement comparing the first half of 2022 to 2023. Operating cash flow basically doubled from $500 million to $1 billion, and then they also purchased acquisition of treasury stock of $220 million, which is down from $521 million year over year. I know it doesn't say it here, but they actually repurchased $87.6 million of common stock in the second quarter. So they are still prioritizing returning a pretty good amount of value back to shareholders. Hopefully that'll be able to combat the slight stock decrease that happened as a result of them failing to meet revenue expectations. Right here, this is a discounted cash flow model to figure out the intrinsic value per share for Chipotle. I'm using a 25% estimated growth rate for this model, and I got that from this historic growth rate calculation. In 2018, Chipotle had free cash flow of around $330 million, and then in 2022, they had free cash flow of $1.05 billion. That's an increase of 25.73% compounded annual growth rate over the last 5 years. So that's what I used for the estimation for the next 5 years. The weighted average cost of capital value I'm using is 9.17% to calculate the discount rate for this discounted cash flow model. And I got that from this weighted average cost of capital calculation right here. We saw from their balance sheet that most of their business is made up of debt or total liabilities. They have about 65% debt and 34% equity, or 35% equity. Cost of debt, which was their interest rate on their debt for the most recent full year, was 10.19%. Effective tax rate was 23.9%. Risk-free return, 10-year treasury yield right now in the market is 4.04%. Chipotle's beta relative to the movement of the rest of the market is 1.32, so they're slightly more volatile. Average market return right now is 10%, and so I calculated the cost of equity by basically taking the risk-free return, which is the 10-year treasury yield, adding that to the company's beta, and then multiplying that by the average market return minus the risk-free return. That shows us that the cost of their equity comes out to be about 11.91%. And that helped me calculate the weighted average cost of capital. Basically, I just multiplied their equity proportion by their cost of equity, added that to the debt proportion, multiplied by the cost of debt, and then multiplied the debt proportion by the tax shield, which is 1 minus their tax rate of 23%. That gave me the weighted average cost of all of Chipotle's capital, which is 9.17%. And that's what I used for this model, as we can see right here. Free cash flow, $1.05 billion for their most recent year. They have a net debt position of a little over $3 billion on their balance sheet and 27 million shares outstanding. Puts their intrinsic value per share at $1,180 per share, which means that at the moment they are not trading below intrinsic value per share. They're currently trading at around $1,900 per share. So you probably want to buy them at a cheaper price if you wanted to buy them at their intrinsic value per share based on these growth rate and weighted average cost of capital assumptions. Then on the right hand side here, I did a competitor/industry analysis comparing them to two of their competitors, McDonald's and Yum Brands. Yum Brands owns some fast food chains like KFC and Taco Bell. We can see that in comparison, Chipotle has the lowest gross profit, net profit, and return on assets. They have the highest price to earnings ratio, and they are the only company on this list that is not paying a dividend. So they're pretty much doing worse on all fronts in comparison to McDonald's and Yum Brand. The higher price to earnings ratio might be because investors are expecting Chipotle to grow at a faster rate than McDonald's and Yum Brands. But I don't think it makes up for the fact that they have a lower profit margin, and they also don't pay a dividend, whereas McDonald's and Yum Brands actually do have pretty competitive dividend yields. So based on this analysis, you'd probably want to give it to McDonald's as they have the highest dividend and also the highest profit margins. Lastly, I wanted to compare Chipotle to some of the other companies we've looked at in past videos. In terms of intrinsic value per share, we can see that they are currently trading at around $1,955 per share. That's about 1.66 times their intrinsic value. Puts them in 10th place, but really not good enough to make them that competitive to any of the other companies on this table. Right now, Google, Alibaba, and Etsy are the only companies we've looked at in past videos that were trading below intrinsic value per share. We can see over here for growth rate, Chipotle comes in third. They have a 25.73% estimated growth rate, puts them in third place on that table. For dividend yield, they don't pay a dividend, so they don't really make it onto the table so far for all the companies we've looked at. Since we added the dividend yield table, 3M has the highest at around 5% dividend yield. We can see that for profitability ratios, Chipotle had a 20% gross profit and a 10% net profit, I believe. So it's not good enough to get them onto the table either way. Adobe has the highest gross profit, 86%. Oxy has the highest net profit at 36% across all of the companies we've looked at so far. For quarter two year-over-year revenue growth, Chipotle increased their sales 13.6% year-over-year for the second quarter. That puts them in fifth place, so not too bad for Chipotle compared to all the other companies we've looked at for the second quarter so far. Tesla had the number one spot at 47% year-over-year revenue growth. And then for earnings growth, they come in fourth place with a 31.5% increase in earnings. That's actually really good, really competitive compared to the other companies. Kura Sushi had the highest at 240% year-over-year second quarter earnings growth. And then lastly, for stock performance, we can see Chipotle comes in sixth place. They have a very competitive 5-year stock chart. They're up 314% over the last 5 years. That is good enough to get them into the sixth place spot. Right now, Tesla holds the number one spot with a 1,144% return over the last 5 years. Definitely pretty impressive. A lot of the companies we've looked at don't even make it onto the table. So it's very impressive that Chipotle comes in sixth place here. So based on this, it looks like they're actually pretty competitive in terms of stock performance and year-over-year revenue and earnings growth. But we can see that from profitability and then also for dividend yield and also for intrinsic value, they're not really that competitive. And lastly, for growth rate, they are also very competitive on that table too. For competitor and industry analysis, They weren't really that competitive at all. You'd probably want to give it to McDonald's or Yum Brands. They have higher profit margins and they actually pay a dividend, whereas Chipotle does not. And based on this discounted cash flow model, where we calculated their weighted average cost of capital, they're currently not trading below intrinsic value per share. So let me know in the comment section down below what you guys think of Chipotle. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.